When I look at markets today, what I see is unmistakable. We are in a massive bubble. And by bubble, I do not mean a casual overvaluation here or there. I mean a condition in which asset prices have been driven far beyond their intrinsic economic value, propelled by a combination of human psychology, central bank policies, and the structural mechanics of credit. To understand the current market bubble, it is crucial to step back and examine the forces at play, the historical patterns that have led to similar situations, and the behavioral tendencies that amplify them. Bubbles do not happen overnight. They evolve over long periods, sometimes spanning decades, and they are often rooted in the same foundational dynamics that create wealth, only pushed to extreme levels. Markets are complex systems. They are influenced by economic indicators, interest rates, fiscal policies, geopolitical conditions, and perhaps most importantly, the expectations and behavior of participants. When people observe rising prices, they tend to extrapolate the trend into the future, believing that gains will continue indefinitely. This is a natural human behavior. It is easier to invest when others are making money, and the fear of missing out, or FOMO, accelerates buying. But in a bubble, this collective optimism becomes detached from reality. Prices rise not because of fundamentals, but because of the self-reinforcing behavior of participants. The more people buy, the more prices go up, and the more they are convinced that the market will continue to climb. This feedback loop is what inflates bubbles to levels that eventually become unsustainable. The current market bubble is multifaceted. We are not only observing inflated stock valuations, we see it in bonds, real estate, private equity, cryptocurrencies, and other asset classes. What is striking about today's bubble is how broadly it spans across asset types, driven in large part by unprecedented monetary policy. Central banks around the world have flooded the financial system with liquidity. Low interest rates, quantitative easing, and other stimulus measures have pushed investors to seek higher returns in riskier assets. When cash yields nothing, investors chase growth, and the willingness to pay higher prices for assets escalates. This creates an environment where valuations are disconnected from traditional measures, such as earnings, dividends, or cash flows. Another element contributing to the bubble is leverage. When borrowing costs are low, both institutional and retail investors borrow to amplify returns. Leverage magnifies gains during the upward phase of a bubble, reinforcing optimism. But it also sets the stage for sharper corrections when conditions change. The interplay between leverage and asset price inflation is critical to understanding why bubbles can become dangerous so quickly. Markets can stay irrational longer than most people anticipate, but when sentiment shifts, the unwinding of leveraged positions can accelerate losses and propagate systemic risk. Behavioral psychology is a key ingredient in every bubble. Overconfidence, herd behavior, confirmation bias, and the tendency to follow trends are universal human traits that financial markets exploit. During a bubble, these traits are magnified. Investors ignore warnings and rational signals because they are swept up in the momentum of rising prices. Historical examples from the Dutch tulip mania to the dot-com bubble to the housing bubble of 2008 show remarkably similar patterns in human behavior, regardless of the era or the asset type. The specifics differ, but the psychology remains constant. Understanding this is critical. Bubbles are not just about economics. They are about human nature and the collective mindset of market participants. Today's market bubble is also characterized by extreme valuations relative to historical norms. Price-to-earnings ratios for major stock indices are at levels rarely seen in history outside of speculative peaks. Corporate debt has reached record levels relative to GDP, and the spread between risk-free rates and high-yield borrowing costs is historically compressed. Even with low interest rates justifying some elevated valuations, the combination of stretched multiples and excessive optimism signals that we are in a fragile environment, investors must recognize that the higher the ascent, the more painful the eventual correction can be. History demonstrates that bubbles do not resolve gradually, they burst, often with significant dislocations to wealth and confidence. Technological innovation, while a driver of economic growth, also contributes to bubble dynamics. New technologies create opportunities for rapid profits, attracting speculative capital. We have seen this in the recent explosion of technology stocks, cryptocurrencies, and other digital assets. Investors tend to assign outsized probabilities to success, overestimating potential returns and underestimating risks. This optimism feeds into valuation expansion, which is further fueled by media coverage, analyst enthusiasm, and social sentiment. It is important to distinguish real technological progress from speculative mania. The former generates long-term wealth, the latter inflates prices detached from sustainable economic reality. Globalization and interconnected markets have added another layer to the current bubble. Capital flows freely across borders, allowing investors to chase returns anywhere in the world. This amplifies price inflation in multiple markets simultaneously. For example, asset price surges in one country can attract capital inflows from others, creating synchronized bubbles across geographies. While globalization increases efficiency and opportunity, it also creates systemic risks. Corrections in one market can cascade globally as financial systems are tightly coupled. The more global the bubble, the more complex the potential unwinding process, and the greater the risk to economies and investors worldwide. Policy decisions, particularly from central banks, play a critical role in shaping bubbles. By suppressing interest rates and providing liquidity, policymakers unintentionally encourage risk-taking and speculative behavior. The challenge is that these measures are often justified as necessary for economic stability or to stimulate growth. While they may achieve short-term objectives, they distort market signals, prices no longer reflect fundamental risk, and capital allocation becomes less efficient. The longer these policies persist, the more pronounced the bubble becomes. Eventually, policy tools may be insufficient to prevent a sharp adjustment as market psychology and leverage dominate outcomes. One of the lessons I emphasize is the importance of cycles. Economic and market cycles are recurring phenomena shaped by debt, credit, spending, and investment behaviors. Bubbles are the natural peak phases of these cycles, and understanding where we are in the cycle is critical for risk management. The current market bubble represents a late cycle phase where optimism is at its peak, risk-taking is high, and the divergence between asset prices and underlying economic value is extreme. Investors who ignore this risk may experience severe losses when the cycle turns. It is also important to consider the role of inequality in fueling bubbles. When wealth concentrates among those who are more likely to invest in financial markets, demand for assets increases disproportionately. This dynamic inflates prices and reinforces the perception of perpetual growth. At the same time, broader populations may be excluded from these gains, which can lead to political and social pressures that eventually influence policy and market outcomes. Bubbles do not exist in isolation, they are embedded in the broader socioeconomic context. Finally, one must recognize that markets are forward-looking. Prices reflect expectations about the future, not the present. During a bubble, these expectations are overly optimistic. Investors expect continued growth, low risk, and favorable economic conditions. When reality fails to meet these expectations, whether due to slowing economic growth, rising interest rates, geopolitical shocks, or other unforeseen events, markets adjust rapidly. The dislocation can be severe as the gap between expectations and reality is corrected. Understanding that market prices are a function of collective expectations, not just fundamentals, is central to understanding the nature of bubbles Factors driving asset inflation. When we talk about asset inflation, we are really talking about the process by which the prices of assets, stocks, bonds, real estate, commodities, private equity, and even cryptocurrencies rise to levels far beyond what fundamentals would justify. Understanding the factors driving asset inflation is critical because it allows investors to see the forces that make bubbles grow and persist. And it provides the insight necessary to make rational investment decisions in a world where prices have become increasingly detached from underlying economic value. There are multiple interrelated drivers, each reinforcing the other, creating a complex system that inflates asset prices over time. To understand this fully, we need to examine each driver in detail and see how they interact to create the conditions we face today. The first and perhaps most influential factor is monetary policy. Central banks around the world have for decades, and increasingly in recent years, engaged in policies that are explicitly designed to influence asset prices. Low interest rates, quantitative easing, and other liquidity programs are intended to stimulate economic growth by lowering borrowing costs and encouraging investment. When interest rates are near zero, traditional safe assets, like government bonds, yield very little, pushing investors to seek returns elsewhere. This creates a search for yield mentality, where riskier assets suddenly become more attractive, not because their fundamentals have improved, but because alternatives are offering inadequate returns. This artificially boosts demand for equities, real estate, and other investments, inflating their prices. The mechanics are straightforward but profound. When central banks purchase bonds, they inject liquidity into the financial system. Banks and investors now have more cash, and because returns on risk-free assets are suppressed, they allocate that cash into higher-yielding, riskier investments. This increases asset prices and reduces perceived risk in those markets. Over time, repeated rounds of such policy create expectations that central banks will continue to support markets. Investors come to rely on the Fed put or similar interventions globally, believing that losses will be limited because central banks will intervene if markets falter. This expectation itself drives further buying, pushing asset prices higher and creating a self-reinforcing cycle of inflation. Credit expansion is another key factor driving asset inflation. When borrowing is cheap, both corporations and individuals take on more debt. Companies issue bonds or borrow to fund stock buybacks, mergers, and acquisitions, artificially boosting demand for their own shares and pushing valuations higher. Individuals take on mortgages, leverage investments in real estate, or use margin to buy stocks. Debt amplifies purchasing power, and the effect is magnified in a low interest rate environment. The interaction between credit and asset prices is central to understanding inflation. Credit allows people to buy more than they could otherwise afford, which pushes prices up, and rising prices encourage even more borrowing. This is the classic feedback loop that has preceded many of the major financial crises throughout history. Another factor is fiscal policy, particularly in countries that engage in deficit spending and stimulus measures. Government programs that inject money into the economy, whether through direct payments, infrastructure projects, or subsidies, increase disposable income for consumers and liquidity for investors. This additional cash finds its way into the markets, contributing to higher asset prices. While these policies may be justified for economic stabilization, they have the unintended consequence of inflating asset valuations, particularly when combined with accommodative monetary policy. The result is an environment in which both government policy and market psychology reinforce each other, pushing asset prices beyond sustainable levels. Investor psychology is an equally powerful factor. Markets are driven not just by economics, but by the beliefs, expectations, and emotions of participants. Optimism, overconfidence, fear of missing out, and herd behavior all contribute to asset inflation. When investors see prices rising, they extrapolate the trend, believing that gains will continue indefinitely. Media coverage amplifies this effect by highlighting success stories and portraying markets as unstoppable. Social reinforcement through financial news, social media, and professional networks creates collective confidence that drives further buying. Importantly, this psychology is self-reinforcing. The more prices rise, the more people believe that growth is assured, creating momentum that fuels further asset inflation. Globalization and the interconnectedness of financial markets are also critical contributors. Capital flows freely across borders, seeking returns wherever they are highest. This means that asset inflation is no longer confined to one market or one country. It can be synchronized across multiple geographies. For example, when the U.S. stock market surges, capital flows into other markets, driving up asset prices globally. Similarly, rising real estate prices in one country attract foreign investment, inflating housing markets in multiple regions simultaneously. Global interconnectedness amplifies asset inflation because investors perceive opportunities everywhere and compete for limited assets, driving prices even higher. Technological innovation is another driver. New technologies promise high returns and disruptive potential, attracting speculative capital. This creates a surge in valuations in sectors like tech, biotech, and digital assets. Investors often assign extreme probabilities of success to these ventures, overestimating potential earnings and underestimating risk. Media coverage, venture capital enthusiasm, and social hype contribute to this phenomenon. While technological progress generates real economic value, the market often prices in expectations far ahead of reality, leading to inflated asset prices. This is particularly evident in sectors like artificial intelligence, cryptocurrencies, and emerging technologies, where speculation often overshadows fundamentals. Market structure and the rise of algorithmic trading, passive investing, and ETFs have further amplified asset inflation. The rise of index funds and ETFs means that money flows into markets indiscriminately based on market capitalization or other criteria rather than company fundamentals. Algorithmic and high-frequency trading amplify short-term trends, pushing prices higher with minimal human assessment of value. These structural changes create additional momentum that inflates assets, often decoupling prices from traditional measures of economic worth. In other words, market mechanics themselves now contribute to asset inflation, beyond human psychology or monetary policy. Inflation expectations in the real economy also play a role. When people expect higher future inflation, they tend to invest in assets that are perceived as hedges, real estate, commodities, precious metals, and stocks. These expectations create demand that pushes up prices in advance of actual inflation. Conversely, when deflationary fears dominate, investors seek safe assets, which can distort other markets. The interaction between expectations, psychology, and real-world outcomes creates an environment in which asset prices can overshoot or undershoot fundamental value, depending on sentiment and perception. Income and wealth inequality further exacerbate asset inflation. Wealthy individuals hold a disproportionate share of financial assets. When asset prices rise, those at the top benefit first and most significantly, reinforcing the cycle of inflation. Increased wealth concentration leads to more capital being allocated to financial markets, increasing demand and pushing prices higher. At the same time, middle and lower income populations often have less access to these markets, meaning that the gains from asset inflation are concentrated among those who are already wealthy. This dynamic not only inflates asset prices, but can also influence political and economic policy in ways that perpetuate the cycle. Demographics also play a subtle but important role. When populations are younger and in wealth accumulation phases, there is more demand for assets as people save and invest for the future. Conversely, aging populations may liquidate assets, affecting price trends. Demographic shifts influence demand for housing, stocks, and other assets, which in turn can amplify inflationary pressures when combined with other factors. For example, the post-World War II baby boomer generation drove housing and equity markets for decades due to their investment and consumption behavior. Geopolitical stability and policy certainty, or the perception thereof, also contribute. When investors believe that governments are stable and markets are predictable, they are more willing to take risks. Conversely, instability can depress asset prices. In today's environment, despite geopolitical tensions, there has been a broad perception that major central banks and governments will intervene to stabilize markets in the event of a crisis. This perception encourages risk-taking, increases demand for assets, and inflates prices. The confidence that markets are backstopped is itself a driver of asset inflation. Finally, speculation and the culture of short-term performance incentives cannot be ignored. Fund managers, corporate executives, and other market participants are often rewarded based on short-term gains rather than long-term value creation. This creates a focus on momentum, trading, and short-term price appreciation, which amplifies demand and contributes to asset inflation. The structure of incentives reinforces buying behavior during the upward phase of a bubble, further disconnecting asset prices from underlying fundamentals. Taken together, these factors form a highly interconnected web: monetary policy, credit expansion, fiscal stimulus, investor psychology, globalization, technology, market structure, inflation expectations, inequality, demographics, geopolitical stability, and speculation all interact in ways that amplify each other. No single factor can fully explain the current level of asset inflation. It is the combination, the systemic interaction of all these forces that creates the conditions for a massive bubble. Recognizing the full spectrum of drivers is essential for understanding both the magnitude of the risk and the potential pathways for adjustment, historical comparisons, and lessons learned. When I examine markets today, I cannot help but see the echoes of history. Financial markets are not random. They are cyclical, and they repeat patterns, particularly in how bubbles form, inflate, and ultimately burst. By studying historical comparisons, we gain the most reliable insight into what drives markets, how participants behave, and what lessons can be applied to avoid catastrophic outcomes. History is not deterministic. It does not tell us exactly what will happen, but it provides a framework for understanding probabilities, behaviors, and the mechanics of crises. There is a reason why I spend much of my time studying the past. It illuminates the recurring patterns that human nature, credit, leverage, and policy create. Consider the Dutch tulip mania of the 1,630 seconds. This is often the first example cited when discussing bubbles, yet it is more instructive than most people realize. Tulips were not merely flowers. They became speculative instruments, assets whose value was driven by perception rather than intrinsic worth. Prices skyrocketed for rare varieties, often reaching hundreds or thousands of times the annual income of a skilled worker. People borrowed money to purchase bulbs, sold assets to acquire more, and believed that the rising trend would continue indefinitely. When the market eventually corrected, wealth evaporated, confidence was shattered, and the economic consequences were severe for many participants. The mechanics we observe in tulip mania, speculative fervor, leverage, irrational extrapolation, and the eventual collapse are mirrored in every major bubble since. Understanding this event teaches us that bubbles are primarily human phenomena, reinforced by leverage and social psychology. Fast forward to the South Sea bubble of 1720, and we see similar dynamics operating on a larger scale. The South Sea Company, which promised vast profits from trade and colonial enterprises, saw its stock rise dramatically as investors imagined enormous future returns. In reality, the company's economic fundamentals were far less impressive than the market believed, yet the excitement and speculation propelled prices far beyond rational valuations. When reality failed to match expectations, the collapse was swift and devastating, wiping out fortunes and triggering systemic crises. One lesson from the South Sea bubble is that rational analysis is often overwhelmed by mass psychology. Investors can be swept up in optimism to the point of ignoring fundamental risks. This pattern is particularly relevant today, as optimism fueled by central bank policy and technology hype drives prices across asset classes. The 1,920 seconds, particularly the U.S. stock market, leading up to the 1,929 crash, provide another critical lesson. During this period, the stock market experienced extraordinary growth. Innovations in finance, the expansion of consumer credit, and the optimism surrounding industrialization and new technologies created a surge in asset values. Investors borrowed extensively to buy stocks on margin, and the belief that prices would never decline became pervasive. Yet, despite clear warning signs, overvalued stocks, speculative behavior, and excessive leverage, the market continued to climb. When the crash came, the fallout was catastrophic, leading to the Great Depression. The lesson here is that structural leverage, combined with speculative behavior and overly optimistic expectations, amplifies the consequences of a market correction. It also teaches us that economic growth alone does not prevent bubbles from bursting. Sometimes bubbles exist despite real expansion. Japan in the 1,980 seconds provides a more recent, instructive example of how asset inflation can span multiple classes simultaneously. Real estate, equities, and corporate debt all inflated to extreme levels. Land prices in Tokyo reached valuations so high that the cost of a single plot exceeded the GDP of some entire countries. Equities traded at multiples far above historical norms, and corporations borrowed extensively, often using their own inflated real estate as collateral. When the bubble burst, Japan entered a prolonged period of stagnation, known as the lost decades. The lesson from Japan is that when asset bubbles are broad and interlinked across sectors, the unwinding process can be prolonged and damaging, creating systemic economic effects that persist for decades. It highlights the dangers of simultaneous inflation across multiple markets, the perils of excessive debt, and the long-lasting consequences of mispricing risk. The dot-com bubble of the late 1,990 seconds and early 2000s offers another instructive case. Technology companies with little to no profits were valued at astronomical multiples based on projected growth and the hype surrounding the internet. Investors ignored traditional valuation metrics, focusing instead on market share, user growth, or even vague eyeballs metrics. The eventual collapse saw trillions wiped from the market, and it illustrated the danger of overestimating potential future profits while underestimating risk. It also demonstrated that bubbles can occur in new sectors where novelty blinds investors to rational assessment. What is important here is that human behavior, optimism, greed, and herd mentality was the primary driver, even in a modern, highly regulated financial system. The 2008 financial crisis, driven by the housing bubble in the United States, provides a more complex and multidimensional lesson. Unlike earlier bubbles, this crisis involved intricate financial instruments, widespread leverage, and systemic interconnections. Housing prices had risen dramatically, fueled by low interest rates, lax lending standards, and the proliferation of mortgage-backed securities. Investors around the world purchased these securities, believing they were safe, only to discover that the underlying assets were riskier than anticipated. When defaults began, the system unraveled rapidly. demonstrating that bubbles are not confined to a single asset class. They can be amplified by leverage, financial engineering, and global interconnections. The lesson is clear. Complexity and opacity in financial markets can magnify the damage when a bubble bursts. It also shows that bubbles often involve not just irrational exuberance, but structural vulnerabilities in financial systems. Historical comparisons also reveal that the timing of bubble collapses is often unpredictable, even to the most experienced observers. In each case, there were signs overvalued assets, high leverage, speculative behavior, but markets can remain irrational far longer than expected. Investors often underestimate the resilience of optimism and the persistence of central bank interventions or government support. This teaches a crucial lesson about humility. Even when fundamentals indicate extreme overvaluation, the timing of a correction is uncertain, and risk management must account for this unpredictability. One consistent pattern across all historical bubbles is the role of credit cycles. Periods of easy credit, low interest rates, and financial innovation create conditions for asset inflation. When credit is abundant, investors can borrow to amplify returns, and the availability of leverage inflates demand for assets. Yet credit cycles are inherently self-correcting. The very mechanisms that fuel inflation, borrowing, and leverage also create vulnerability to contraction. When asset prices fail to meet expectations, deleveraging occurs, and the system corrects, sometimes violently. Understanding the mechanics of credit cycles is essential for recognizing bubbles and anticipating potential outcomes. Behavioral lessons are equally significant. In every bubble, the same psychological patterns repeat: overconfidence, herd behavior, extrapolation of trends, and the tendency to ignore warning signs. Social reinforcement amplifies these behaviors as investors seek validation in rising markets. Historical bubbles show that awareness of these tendencies can help investors resist the herd, avoid excessive leverage, and protect capital. Yet the challenge is that behavioral forces are deeply ingrained and difficult to overcome, making bubbles almost inevitable in human financial systems. History also teaches us about the policy response to bubbles. In some cases, governments and central banks act to prevent or mitigate crashes. In others, they react too late. Policy interventions can prolong bubbles or distort markets, as seen in Japan, the United States post-2008, and more recently during global quantitative easing programs. While intervention may stabilize markets temporarily, it does not eliminate the underlying dynamics of overvaluation and leverage. Investors must recognize that policy can influence timing and severity, but it cannot fundamentally prevent the risks inherent in inflated markets. Another lesson from history is that diversification and risk management are essential. Bubbles often concentrate in certain asset classes or geographies, creating asymmetric risks. Historical examples show that those who recognize early warning signs and adjust portfolios, reducing leverage, diversifying holdings, and maintaining liquidity fare significantly better than those who are fully exposed. This is a practical takeaway. Understanding the historical patterns allows investors to make decisions that protect wealth rather than chasing irrational gains. One important historical lesson is that bubbles often create opportunities, even amid risk. While excessive optimism leads to overvaluation, subsequent corrections present opportunities to acquire assets at discounted prices. Investors who are disciplined, patient, and informed can benefit from the cycle rather than suffer from it. Understanding the historical arc of bubbles' formation, expansion, peak, collapse, and recovery provides a roadmap for both risk management and opportunity identification. We can also observe that bubbles differ in scope and impact. Some are localized, affecting specific sectors, such as technology in the dot-com era. Others are broad, impacting multiple asset classes, as in the Japanese bubble or the 2008 housing crisis. The broader the bubble, the more systemic the consequences. Historical experience shows that understanding the breadth of asset inflation is as important as understanding individual asset overvaluation. Investors must assess both micro and macro risks to navigate periods of elevated market stress effectively. Another critical lesson from history is the role of innovation in creating both opportunity and risk. In many bubbles, new financial products, technologies, or investment vehicles create excitement, attract speculative capital, and inflate prices. Yet innovation also introduces complexity and uncertainty. The lesson is that while innovation drives progress, it can also amplify behavioral biases and systemic vulnerabilities, particularly when combined with leverage and loose monetary policy. Finally, history teaches us that preparation, discipline, and humility are central to navigating bubbles. Investors must respect the lessons of the past, recognize patterns of human behavior, and manage leverage carefully. Bubbles are inevitable, but the degree of risk can be managed through awareness, prudence, and strategic positioning. Historical comparisons provide not just a warning but a guide for how to act in markets that are inflated, volatile, and influenced by forces that are often beyond the control of any single participant. Risks and implications for investors. When we consider the risks and implications for investors in a market that is clearly in a bubble, it is essential to understand that these risks are both obvious and subtle, immediate and long-term, individual and systemic. Investors face not only the potential for loss of capital, but also the consequences of behavioral errors, misjudged timing, overconfidence, and structural vulnerabilities in the financial system. The first point to recognize is that markets do not operate in isolation. They are interconnected systems in which psychology, leverage, policy, and global economic forces interact in ways that amplify both risk and reward. Ignoring these connections is one of the most common mistakes that leads to significant losses during periods of asset inflation. The most immediate risk is valuation risk. In a bubble, asset prices have risen far beyond the level justified by fundamentals such as earnings, cash flow, or replacement cost. When prices are elevated, the potential for correction increases. Investors who enter at the peak or near peak levels risk severe capital erosion. Historically, market peaks are followed by sharp declines, sometimes exceeding 50% in equity markets or similar percentages in other asset classes. The danger is that high valuations are not sustainable indefinitely. The longer prices remain elevated, the greater the vulnerability to sudden shifts in sentiment, policy, or economic conditions. Leverage risk is another critical concern. Many investors, both institutional and retail, use borrowed funds to amplify returns, especially when interest rates are low. Leverage can magnify gains during the inflationary phase of a bubble, but it also magnifies losses when markets correct. A modest decline in asset prices can trigger margin calls, forced liquidation, and cascading losses. This creates feedback loops that exacerbate the downturn. The 2008 financial crisis exemplifies this dynamic. Leveraged positions in mortgage-backed securities, combined with overconfidence in risk models, propagated losses throughout the financial system. For today's investors, leverage is a double-edged sword. It offers the illusion of greater opportunity, but introduces catastrophic risk if the bubble begins to deflate. Liquidity risk is also heightened during bubbles. In an inflated market, assets may trade at elevated prices under normal conditions, but during stress, liquidity can disappear rapidly. Markets that seem stable and deep can become shallow, making it difficult to sell positions without significantly impacting prices. Investors who fail to maintain adequate liquidity or underestimate the potential for sudden market illiquidity are exposed to sharp declines and may be forced to sell at steep losses. History demonstrates that liquidity evaporates precisely when it is most needed, and planning for this eventuality is essential for risk management. Behavioral risk is often overlooked but is pervasive in bubble environments. During periods of rapid asset inflation, human psychology encourages overconfidence, herd behavior, and the illusion of invulnerability. Investors who ignore historical patterns, rational valuation measures, or warnings from experienced analysts often find themselves caught off guard when sentiment shifts. Fear and greed drive decisions that exacerbate losses, creating a pattern in which individuals consistently make poor choices under extreme market conditions. Recognizing these tendencies and developing strategies to mitigate behavioral biases is crucial for investors who wish to navigate bubbles successfully. Systemic risk is another layer of concern. A bubble in one market rarely exists in isolation. Interconnected markets, global capital flows, and cross-border investments mean that corrections can propagate quickly and broadly. A collapse in equities can affect credit markets, real estate, and commodities simultaneously, creating cascading effects. The 2008 crisis illustrated the danger of systemic risk. The housing market correction, combined with highly interconnected financial institutions, triggered a global recession. For modern investors, understanding the systemic interconnections between asset classes, institutions, and economies is vital to anticipating potential ripple effects of market corrections. Policy and regulatory risk also play a critical role. Central banks and governments can influence markets through interest rates, liquidity provisions, and regulations. While these interventions can temporarily stabilize markets, they can also create moral hazard, encouraging risk-taking and inflating asset prices. Investors must consider that policy responses may be delayed, insufficient, or create unintended consequences. The assumption that authorities will always prevent market declines is dangerous, as policy may not act quickly enough to prevent losses for those heavily invested in inflated assets. Interest rate risk is particularly relevant today. Low interest rates have been a major driver of asset inflation, but changes in rates can have dramatic effects on valuations. Rising rates increase the cost of borrowing, reduce present value calculations for future earnings, and shift investor preferences toward safer assets. In a bubble, even modest increases in rates can trigger substantial declines in asset prices, as the margin of safety that supported high valuations disappears. Investors must understand the sensitivity of their portfolios to interest rate changes and plan accordingly. Inflation risk interacts closely with asset price risk. When inflation accelerates, it can erode the real value of returns, particularly in fixed income assets. Conversely, some assets, like equities or real estate, may initially act as hedges, attracting capital and further inflating their prices. However, if inflation becomes unpredictable or exceeds expectations, policy interventions or market reactions can trigger sharp adjustments in asset valuations. Investors need to assess not only current inflation, but the likely trajectory of inflation and its impact on asset classes, borrowing costs, and portfolio risk. Currency risk is also magnified in global markets. Investors holding assets in foreign currencies face exposure to exchange rate fluctuations. In a bubble, capital flows can amplify currency volatility as investors move funds in search of higher returns or perceived safe havens. Sudden reversals can erode returns for global investors, particularly in emerging markets or markets reliant on foreign capital. Managing currency risk through diversification, hedging, or strategic allocation is essential in a bubble environment where capital movements are rapid and unpredictable. Sector-specific risk is another important consideration. In bubbles, certain sectors often inflate disproportionately, whether technology, real estate, energy, or alternative assets. Concentrating investments in these sectors can yield large gains during the inflationary phase, but exposes investors to dramatic losses when corrections occur. Historical analysis shows that sector concentration amplifies volatility and risk, making portfolio diversification a critical tool for managing exposure. Even sectors with strong fundamentals are not immune if they are caught in the speculative frenzy surrounding a broader bubble. Liquidity of specific asset classes is particularly relevant for private and alternative investments. Private equity, venture capital, and certain alternative assets may appear to offer high returns, but they often lack liquidity, making it difficult to exit positions when markets turn. Investors in these instruments are exposed to the risk that valuations may be marked artificially high during the bubble, with realization of true value only possible during periods of stress. Understanding the liquidity characteristics and exit options of investments is vital for assessing the risk-reward trade-off. Counterparty risk is another factor that cannot be ignored. Many market transactions involve multiple parties, derivatives, and structured products. During periods of market stress, counterparty defaults can magnify losses, as was seen during the 2008 financial crisis. Investors must evaluate not only the assets they hold, but the broader network of exposures that could impact value in extreme conditions. Overlooking counterparty risk can turn a nominal correction into a systemic loss. Behavioral implications for individual investors are profound. One of the greatest dangers in bubbles is the tendency to chase returns at the peak of asset inflation. The fear of missing out drives late entrants into markets, often at the worst possible time. History shows that the average investor frequently buys high and sells low, driven by emotion rather than rational analysis. Developing discipline, patience, and adherence to valuation-based investment principles is essential to mitigating behavioral risk. Investors must also recognize that timing is highly uncertain, and managing exposure rather than attempting to perfectly predict the top of a bubble is often the more rational approach. Long-term implications include the erosion of wealth, the potential for financial dislocation, and disruption of retirement and savings plans. For example, individuals heavily invested in inflated equities or real estate may see their net worth decline sharply during corrections, impacting future consumption, retirement readiness, and intergenerational wealth transfer. Institutional investors, including pension funds and endowments, may face funding shortfalls if asset inflation reverses unexpectedly. These long-term consequences underscore the importance of comprehensive risk management, strategies, stress testing, and scenario planning. Another implication for investors is the need to consider hedging strategies. In bubble conditions, the use of options, derivatives, or other hedging tools can protect portfolios against sudden declines. However, these instruments also carry costs, complexity, and risks of their own, and must be employed thoughtfully. History demonstrates that proactive hedging, adjusting positions to reflect potential downside, can preserve capital, whereas failure to hedge can result in catastrophic losses. Effective risk management is not simply about achieving gains, it is about protecting capital during periods of market instability. The implications of leverage, particularly in institutional portfolios, are profound. Many hedge funds, private equity firms, and corporate investors utilize borrowed capital to amplify returns. While leverage can produce outsized gains during asset inflation, it also creates the conditions for forced liquidation, margin calls, and cascading losses when corrections occur. Understanding the interaction between leverage, liquidity, and asset valuation is essential for institutional investors, as it determines the magnitude of potential losses during a downturn. Strategies to protect wealth in a bubble. When we discuss strategies to protect wealth in a bubble, the starting point is understanding that bubbles are periods of elevated risk in which asset prices are inflated beyond sustainable fundamentals. These periods are characterized by irrational exuberance, excessive leverage, and the amplification of behavioral biases. Protecting wealth is not about eliminating risk entirely, that is impossible, but about recognizing the risks, positioning intelligently, and preparing for multiple outcomes. It requires discipline, diversification, foresight, and humility. The first and most fundamental strategy is diversification. Diversification is often misunderstood. Many investors believe that simply holding a mix of assets, like stocks and bonds, is sufficient. In a bubble, however, conventional diversification may not provide true protection. When asset prices across multiple classes rise simultaneously due to systemic factors, correlations increase, and losses can occur across the board. Therefore, effective diversification must be multidimensional. It should include asset classes, geographic regions, currencies, sectors, and even investment styles. For instance, owning global equities, domestic and foreign bonds, real estate, commodities, and alternative assets can help mitigate the risk that a bubble in one sector or country wipes out wealth. Diversification also includes time diversification, staggering entry points, systematically rebalancing, and adjusting exposures as valuations change. Liquidity management is the second crucial strategy. In a bubble, liquidity is often abundant, but it can disappear very quickly when sentiment shifts. Investors must maintain sufficient cash or highly liquid assets to meet obligations, take advantage of opportunities, or avoid forced sales at depressed prices. Liquidity management is not simply holding cash, it involves understanding the liquidity characteristics of all holdings. Private equity, venture capital, or real estate investments may seem profitable but are illiquid, making them highly risky in a bubble environment. Maintaining a balance between illiquid, high-return assets and liquid, flexible assets is essential for preserving capital. Leverage management is equally important. Leveraged positions can magnify gains during a rising market, but they also magnify losses during a correction. In a bubble, leverage is particularly dangerous because small declines in asset prices can trigger margin calls, forced liquidations, and cascading losses. Strategies to protect wealth include reducing or eliminating leverage, limiting exposure to highly leveraged instruments, and stress testing portfolios to evaluate how they would perform under adverse scenarios. Historical bubbles from the 1929 crash to the 2008 financial crisis show that even modest leverage can transform a temporary downturn into a catastrophic loss. Therefore, controlling leverage is not optional. It is a central aspect of protecting wealth in an inflated market. Hedging is another fundamental tool for protection. Hedging involves taking positions that gain value if the market moves against your primary holdings. Common methods include options, futures, and inverse ETFs, though more sophisticated strategies can involve complex derivatives or alternative investments. The goal of hedging is not necessarily to profit from market declines, but to offset potential losses and preserve capital. Effective hedging requires understanding correlations, market volatility, and potential downside scenarios. It also involves recognizing the costs of hedging, such as premiums or reduced liquidity, and weighing them against the potential benefits in protecting wealth during a bubble. Portfolio stress testing is a proactive strategy closely related to hedging and risk management. Investors should model multiple scenarios, including rapid market corrections, interest rate shocks, and geopolitical crises. Stress testing reveals vulnerabilities that may not be obvious in normal market conditions and provides insight into which assets or positions could amplify losses. For example, a portfolio heavily weighted in growth stocks with high valuations may perform well during the inflationary phase of a bubble, but could lose significant value if rates rise or sentiment shifts. Stress testing allows investors to adjust exposures, improve diversification, and implement hedges before losses occur. Risk-adjusted allocation is critical during a bubble. Instead of focusing solely on expected returns, investors should prioritize strategies that balance potential gains with the likelihood and severity of losses. Assets with Historically low volatility and strong fundamentals should be weighted more heavily, while highly speculative assets should be limited. Risk-adjusted allocation also involves continuously monitoring valuations, correlations, and macroeconomic conditions. During a bubble, what appears safe one day may become dangerous the next, so flexibility and vigilance are essential. Behavioral discipline is perhaps the most underappreciated strategy. In bubbles, human psychology is the primary driver of asset inflation. Fear of missing out, herd behavior, and overconfidence push investors to take excessive risk. Maintaining discipline, sticking to a long-term plan, avoiding speculative frenzy, and resisting emotional reactions is vital. Investors must recognize their own biases, develop rules-based strategies, and commit to them even when market sentiment pressures them to act impulsively. Historical evidence consistently shows that disciplined investors who resist the allure of bubbles outperform those who chase short-term gains. Strategic timing and phased exposure are also essential. While it is impossible to predict the exact peak of a bubble, investors can manage exposure through gradual scaling in and out of positions. For example, incrementally reducing exposure to highly inflated assets as valuations become extreme can limit downside risk while allowing participation in continued gains. Similarly, gradually increasing exposure to undervalued or defensive assets prepares the portfolio for a market correction. This approach balances the opportunity to earn during the bubble with protection against its inevitable collapse. Alternative investments can provide additional protection. Assets such as commodities, precious metals, or inflation-protected securities often behave differently from equities or traditional bonds during market stress. Gold, for example, has historically preserved purchasing power during periods of financial instability. Real assets like farmland or certain types of real estate may offer stability, particularly if they produce income streams. Alternative strategies, including long-short hedge funds, market-neutral strategies, and global macro funds, can provide returns uncorrelated with broad market trends. Allocating a portion of wealth to these alternatives can reduce overall portfolio risk during a bubble. Debt management is another crucial aspect of protection. Individuals and institutions alike should minimize exposure to variable rate debt, adjustable loans, and other liabilities that could become burdensome if market conditions shift. Debt amplifies vulnerability, especially when asset prices fall or liquidity tightens. Reducing debt, refinancing at fixed rates, and ensuring sufficient liquidity to service obligations are fundamental strategies for surviving a bubble without forced liquidation. Monitoring macroeconomic indicators is essential for strategic positioning. Changes in interest rates, inflation, expectations, central bank policies, and global economic trends all influence asset prices and the timing of corrections. Investors should develop the ability to interpret these indicators, anticipate shifts, and adjust portfolio allocations accordingly. For example, signs of rising inflation combined with elevated valuations in equities and real estate may signal the need for risk reduction, liquidity preservation, and defensive positioning. Global diversification is particularly relevant in today's interconnected markets. Bubbles may occur simultaneously in multiple countries or asset classes, but they rarely inflate identically. Investing across different geographies can reduce the risk of localized corrections wiping out wealth. International equities, bonds, real estate, and alternative investments provide exposure to diverse economic conditions, policy environments, and currency movements. By balancing global exposures, investors reduce the probability of being fully caught in a regional or sector-specific bubble. Scenario planning and contingency preparation are also critical. Investors must develop multiple plans for different market outcomes, including sharp corrections, policy changes, or systemic crises. Contingency planning involves not only portfolio adjustments, but also operational readiness, liquidity reserves, and psychological preparation. Those who prepare for multiple scenarios are better equipped to act decisively and avoid panic-driven mistakes when markets turn. Understanding the tax implications of portfolio adjustments is important. Selling appreciated assets during a bubble may trigger capital gains taxes, but delaying action exposes wealth to potential losses. Strategic planning, including tax loss harvesting, asset location optimization, and careful timing of sales, can preserve after-tax wealth while managing exposure to inflated assets. Taxes should not dictate investment strategy, but they are an important consideration when protecting wealth during volatile periods. Insurance and protective structures can complement investment strategies. For example, life insurance, annuities, or other wealth-preserving instruments may provide stability and income during periods of market turbulence. Trusts, holding companies, or structured investment vehicles can protect capital from sudden shocks, provide flexibility, and enable strategic repositioning. While these tools do not prevent losses in markets, they offer additional layers of protection for wealth in highly uncertain environments. Continuous education and awareness are indispensable. Markets evolve, new financial instruments emerge, and historical patterns repeat in modified forms. Investors must remain informed, understand emerging risks, and continually update strategies based on changing conditions. Knowledge of history, market mechanics, behavioral finance, and global economics equips investors with the tools to anticipate risks and respond intelligently rather than react impulsively. Finally, patience and long-term perspective are fundamental. Protecting wealth in a bubble is not about timing every peak perfectly, but about maintaining a disciplined approach that balances risk and opportunity. Bubbles are temporary, and historically, markets recover and create new opportunities once the inflationary period ends. Those who preserve capital, manage risk, and act rationally during the bubble are positioned to benefit when the market eventually stabilizes and begins a new growth cycle.